Hey, Jason here, and in this video I want to talk about working capital. It's a question I get asked a lot. Jason, where do I find the working capital? That capital that I'm going to use to ensure that the business can make payroll and buy materials or inventory and keep the lights on and pay rent and all of this stuff after I make the acquisition. Oh, and by the way, I'd love to be able to pay out both myself and my team and maybe a lawyer or an accountant who's been helping me, perhaps an industry expert. Where do I get those funds? Where do I get that money? Well, first things first, it really depends on how you've structured the prior portion of the capital stack, right? Say you're making a $1 million acquisition, just to keep the number simple. Okay, let's say that you're gonna raise $900,000 in bank debt. Okay, so that's 90% of the capital stack right there, but you still have another $100,000 you need to raise to get the deal done, and then you need working capital, okay? So let's then say that there's a $50,000 seller note. The seller is gonna carry a $50,000 note. Okay, now you're up to $950,000. Let's then say that you're able to raise $50,000 from somebody in your network that believes in the deal. And maybe you're gonna give them a little bit of the equity of the business acquisition in exchange for that $50,000. Okay, so now you're up to $1 million. You have all of the monies you need, at least in theory, to close the deal. But do you? Do you really have all the money you need? And the answer is actually no. Because first of all, any of you who have closed a transaction know that there are closing costs. You're probably gonna have to pay an attorney. You may have had to have paid an accountant to help you with due diligence. Perhaps you brought an industry expert on to help you analyze the acquisition a little bit more comprehensively. Oh, and then by the way, you're gonna have to make payroll, you're gonna have to buy materials, you're gonna have to keep the lights on. I mean, how are you gonna make the business operate the day after you buy it if you don't have any working capital? And so a couple of ways you can find working capital. First of all, you can find lenders that specifically offer working capital. And often they will give you money based on the receivables of the business. So I've heard of things wherein, okay, if the business has $150,000 worth of receivables, the working capital group, and often this is a lender, they will provide you, say, 80% of the receivables. So if the company has $150,000 in receivables, then they may give you $110,000 or $120,000 in working capital. Another way you can get working capital is to overfinance the deal by getting that first position lender to extend further. Okay, so maybe now let's back up and say on a $1 million deal that you were able to get the seller to carry 20% of the capital stack. So the seller in a second position note is gonna contribute $200,000 to the capital stack. You're gonna pay him out over time or her over time down the road in the future, okay? And let's say now you're still able to get the lender to loan $900,000. Okay, so let's do some simple math. 900,000 plus 200,000 equals 1.1 million, but hey, the acquisition was only 1 million, right? So now you already have $100,000 worth of overfinance, of working capital, right? You've overfinanced the deal $100,000. And then let's say you still have that individual in your network that contributes $50,000 to the project. You watch my How to Raise Private Equity video and you know how to raise private equity now, so you were able to do so. So you got somebody to contribute $50,000. So now you have 1.15 million contributed to the project, yet it's only a $1 million acquisition. So okay, maybe there's $50,000 in closing costs. That's a little high, but it could be the case for a $1 million transaction. Okay, now you still have $100,000 worth of working capital. Maybe you leave $50,000 in the business and you pay yourself $30,000 and you pay your team $20,000. I'm just spitballing here, okay? There's a lot of ways you can get this done. But ultimately, you can get working capital from a working capital specific loan that's usually gonna be leveraged against either the receivables of the business or in some cases the assets of the business. But usually if you're using acquisition financing, the lender already is gonna have the first lien on the assets. So usually you're gonna leverage the receivables to get the working capital if it's a different loan. But also, in probably the more easy way, is just the combination of a high leverage first position loan. That's the main loan that's gonna give you the majority of the money to buy the business, in combination with a seller's second loan, combined with raising a little bit of private equity. And you stack all of that up, right? 900,000 plus 100,000 plus 50,000. And now you have raised 1.15 million to make a $1 million acquisition. You have 150,000 in working capital. Again, the closing cost for a $1 million deal, you're probably only looking at like 20 grand, maybe 30. So there, you should be able to keep about 120,000 in the kitty. And maybe of that, you realize you need 80,000 in the business and now you can pay yourself 30 and pay your team 10. I don't know, I'm spitballing here. There's a million ways to do it. But look, you can always raise private equity. But remember, if you're going to raise private equity, give away the equity at the subsidiary, not at the parent company, because it's better for you and your investors if you do it that way. And here's why. If you give away too much equity at the parent company, then you are going to lose control of all of the business interests from which you're trying to put forth. And then the ship basically loses its rudder. And a ship without a rudder crashes. And everybody goes down with the ship, and you don't want that. So as the captain of the ship, you need to keep control of the rudder. This means you don't give away equity at the parent company, at least not liberally. You give it away at the deal specific level, at the subsidiary. Give away equity at the subsidiary if you're raising capital and bringing on investors. Okay, and I've talked more about how to raise capital, but that's always an easy way to raise money. It's just to go to the private market. Go to people who have money, accredited investors. You can think of doctors or lawyers or accountants or surgeons. You can think of family offices. You can think of wealthy individuals that you know in your immediate network. I mean, not everyone, but a lot of people have money. A $50,000 check is not that hard for a fairly wealthy individual to put forth. And by the way, you can raise money through an IRA or a 401k. I talked about that somewhere here on YouTube as well. A lot of retirement accounts, you can access those monies from accredited investors and get those monies into your deal. Okay, but again, you can also get working capital. You can also do bridge loans or mezzanine debt, which is basically a high interest rate, second position debt instrument. I've never raised mezz nor bridge debt. Those are basically synonymous, and there's some nuance there about exactly how it's classified. I've heard of examples where it's equity that converts to debt, or it's debt that can convert to equity, or it's just high interest second position debt. Bridge finance, it bridges the gap in your capital stack, right? You can just get a first position loan that goes further across the capital stack, and then you stack on a seller's second, or bridge finance, and then the private equity that you raise, and that's how you overfinance a deal. Okay, there's a number of ways. There's factoring. Factoring is basically working capital that leverages against receivables of a business or contracts that a business has. So if a business has $500,000 worth in contracts, you can use a factoring. It's basically a factoring group that will give you that money in advance because they know that the sales are coming. Again, it's basically receivable lending. But be wary with that. I've heard of many stories where people get too excited being able to raise money based on either receivables that they have coming in or sales contracts that they are soon to begin that will soon generate revenue. They take these monies in prematurely and then they spend that money willy-nilly, or they pay their team, or they buy a Rolls Royce, or they basically just go crazy with the monies that they've taken in that's leveraged against these receivables or against these sales contracts. And then when push comes to shove, they realize they haven't managed their money correctly. They've been renting a Lambo to look cool on Instagram, and then they're not able to make payroll, and then they go broke. And that's a very clever way to do business. Of course, I'm being sarcastic. So be intelligent with how you raise money. And this is one of the keys to raising money in general. Rather it's debt, equity, overfinance, pretty much anything. If you show discipline with finance, people will trust you with their money. And if you show emotion or overexuberance and foolishness with money, nobody's going to trust you with it, and you won't be able to raise a nickel. That's what I've seen firsthand. Passing on a number of deals this year has helped me raise more money. We have more than doubled our equity commitment that we have in Brighter Utilities over the last 60 days. We could do a lot more in deal size. And in just in general, we can do a lot more right now than we've ever been able to. Why? Because we have more powder, more dry powder, more private equity that's been contributed, and it's committed to us. It's ready to be deployed for the deal we think we're getting done right now. But just in general, we have more commitments, more excitement, more readiness to contribute capital to our projects that I'm leading than ever before. And that's because I've shown discipline. And I'm not trying to toot my horn. I hear from the people that are contributing money. I ask them, hey, why are you feeling confident in what we're doing? They say, because I respect your vision. I trust your vision, Jason. And because you show strong discipline. And I know that you are watching out for me and that I trust you, and that's what they tell me. That they trust me, they respect my discipline, and they believe in the vision. And they believe in the sector, of course, as well that we're getting into. So these are things to keep in mind when you're raising money. You have to have a compelling vision that really enlists excitement in the form of return on investment. Or if it's on the debt side of the capital stack, right? Because you're talking more about upside when you're raising equity. When you're raising debt, it's really more about ensuring that you don't fail. Because lenders don't get a piece of the upside. You could have tremendous success or only mediocre levels of success. The bank is still just going to get paid principal plus interest. And that's it. There's no difference in how much you pay the bank based on whether you have tremendous amounts of success or mediocre amounts of success. Whereas for investors, it's very different, especially if you give them equity in the subsidiary so that they get to participate in the distributions that the company has. So the sales pitch for equity is different than the sales pitch for debt. Never forget that. Raising debt is much more of a conservative process because lenders can't afford to fail. I've heard lenders tell me, I heard an underwriter, I was speaking with an underwriter last week for the Florida deal. We're getting set to hopefully close here. There's a little bit of some interesting stuff going on there, but we're very optimistic everything's going to be taken care of. We'll get that deal closed ostensibly here very soon. But when I was speaking to the underwriter of that deal, he told me that the lending group he works with has the ability to fail 1% of the time. For every 100 loans they make, the most they can fail while still being in a profitable business model is 1%. So for every 100 loans they make, 99 of them have to be successful. So that's why lenders are so conservative. Because they don't get that high upside, they have to make sure that they don't strike out. Whereas investors, I mean, you think of angel investors, gosh, they strike out 9 out of every 10 times at bat. So understand when you're raising money who you're talking to. What part of the capital stack does this person fall on? And of course, don't just sell people based on telling them what they want to hear. Make sure your capital stack actually makes sense. Make sure you're buying the business at a low enough multiple so that you can easily make sure you pay off the debt and make sure you give your investor or your investors upside if you have investors. Make sure you can make your payments on your second position debt note, whether it's a seller second or a bridge note that follows the first position bank note that's providing you the majority of the financing for doing the acquisition. Right? So you have to be thinking about these things. But when you do, and you really have a great sector, you think about operations intelligently, you bring on the right team, you have a great accountant, a great lawyer, a great industry expert, you think about management, you buy a company that has existing management, or you use your recruiting ability to bring on a great manager from the very beginning. When you're willing to roll up your sleeves and get dirty for a minute or two if necessary to ensure you stabilize the acquisition, when you're thinking about sales and marketing and customer retention, when you're really being shrewd with due diligence, when you're willing to walk away, and when you show the discipline to make great decisions, even when they're hard decisions, you'll find that raising the money isn't the problem. I looked the seller in the face. This guy's got a company that does about $8 million a year in sales. I'm actually going to go visit him this weekend. I looked him right in the face on a Zoom call, and I meant it in all sincerity in the world. And I told him, look, and this guy's got he's got a wonderful business. I'd love to buy it. And I told him, look, getting the money for your business will not be our problem. It'll be the day after we close, because it's in a sector, they do large jobs. It's a fairly complicated operation, which is why I've told him that if we do the deal, I'm going to need him to stay on for at least a year, which he's seemingly agreed to. But I told him straight in the face, I looked him right in the face and said, look, raising the money for this deal, if everything checks out, will not be my problem. It will not be our problem. We will be able to raise the money for this deal if it all pencils out in due diligence. My challenge is going to be making sure we keep it profitable after closing, which is again why we're going to need to keep you on board. How am I able to speak with that level of confidence? One, I'm starting to build a track record and it's starting to snowball. We have more private equity committed to us right now than ever before. Our real estate property in Nebraska is performing better than ever before. We have more connections with lenders than ever before. I have more connections with investors than ever before because I'm always putting in the work, always growing my network all the time. But more than any of that, it's really the discipline that I've shown to be discerning about investments and about acquisitions so that I have that trust from lenders and investors alike. They start to know me now as the guy that's pretty discerning. When you pass on deals 4 or 5 or 6 times in a year, these lenders and investors alike realize, man, this guy's for real. He actually practices what he preaches. Not every light that this guy sees is green. This guy understands yellow and red. That's the reputation I really would implore you to build for yourself. Because I've heard plenty of stories of people who just buy, and not all of them are succeeding. Sometimes they get underneath, they can barely make payroll, they're struggling. Why? Because they bought a couple of lemons. You cannot afford in business to buy lemons. It's the old Warren Buffett, and I'll leave you on this. Rule 1, never lose money. Rule 2, refer to Rule 1. I'll leave you on that note. Except for so as to say, look, if you like this video, be sure to thumbs it up, subscribe to the YouTube channel, share your comments below. I want to talk to you. I know I haven't been making as many videos lately. It's because I've been hunting for deals, raising money, doing all of that. I'm practicing what I'm preaching out here. So yes, I've been busy. That's why I haven't been making as many videos, but please share in the comments below. I want to hear from you. I will talk to you in the next video. And I'm wishing you nothing but the best.